Hey guys, it's Paul here. In today's video, we are again going to take a look at potential post-corona recovery stocks. As usual, I picked one stock that is very well known and then two others that are doing business in the same industry. The company in question is McDonald's, ticker symbol MCD, and the two, let's say, competitors are Texas Roadhouse, TXRH, and Restaurant Brands, QSR. Like in my other stock comparisons, I'd first like to say a few words about the companies in question before I start discussing the fundamentals and showing you the beautiful charts generated by my application. So here we go. McDonald's should be the most well-known company of these three and is probably one of the best-known brands worldwide as well. Every day, 68 million people step into a McDonald's restaurant. This is 750 per second. I think that it is unnecessary to talk about the products they sell, but there still are a few things about the company's business model and especially assets that are crucial for you potential or already investors of that stock. In the 1950s, the McDonald's brothers recognized the trend of hamburgers becoming the Americans' favorite food. Many local burger restaurants opened, but despite the simplicity of a burger, the preparation time of them was pretty long there, leading to long queues before the restaurants. That's where the two brothers saw their opportunity of optimizing the preparation process and opening a restaurant specialized on selling just burgers. Like so, they managed to become not only the fastest, but as well the cheapest provider around. It worked so well that they were able to open one restaurant after another. Today, McDonald's burgers are sold in around 38,700 restaurants in 119 countries. In this time span, from 1950 till today of course, happened a lot, and I don't want to discuss it in detail right now. There's a good film about it, called The Founder, if you're interested, telling the whole story. What I want to say right now is that today, McDonald's is not operating the whole 38,700 restaurants on their own. Especially in the last years, they started to aggressively franchise their business model, leading to franchise holders operating around 93% of all McDonald's restaurants. In a minute, we will see if this strategy paid off or not. Another, at least equally important fact about McDonald's is that they are one of the largest real estate owners worldwide. Little more than half of their restaurants 100% belong to the company, including the land they are built on, valued at around $39 billion today. This is insane because many of the buildings are located in big cities and oftentimes in excellent locations. The management of McD definitely has a sense for doing business, that's for sure. Restaurant Brands resulted out of a merger of Burger King, Tim Hortons and Popeyes Chicken and Biscuits in 2014. They are based in Toronto and operate around 26,000 restaurants in 100 countries as well, including many of them operated as franchises. What should be mentioned at this place is that the Brazilian investment company 3G Capital is currently holding around 51% of the shares of Restaurant Brands. Their current strategy is to expand aggressively by opening around 1,000 new restaurants per year, to cut costs by franchising and digitalizing, and to switch from cheap to higher order products. Last but not least, Texas Roadhouse. This is an American steakhouse restaurant chain that makes vegetarians have sleepless nights. It was founded by the former KFC manager Ken Taylor that wanted to start his own business in 1993, concluding 76 subsidiaries in only 2000. Today exist around 600 of them, mostly in the USA, with about 20% of them operated as a franchise. But before this video is getting too long again, let's get to the point that I ask you to smash the like button and to subscribe to the channel if you're interested in more stock comparison videos. Now that this is done, we can jump into the fundamentals worked up by my beautiful application. And you can see here that there's a huge difference in market capitalization regarding today's companies. McDonald's market cap is 5 times that of Restaurant Brands, which again is 5 times that of Texas Roadhouse market capitalization. Keep that in mind for when we look at the fundamentals growth later. Looking at the candlesticks charts, you can see that you would have made profits regardless of the company here. Sadly, Restaurant Brands is not listed on the stock exchange as long as the others, but we'll have to live with that. Since 2010, McDonald's is up around 3-fold and Texas Roadhouse is up 6-fold. By buying Restaurant Brands shares, you would have at least made 44% since 2015, which is less, but as well a smaller time frame. These numbers are without the dividends that all three companies pay. So let's get to the revenues and the earnings charts to see how sustainable this growth is or was. And this is where things are getting interesting. The first impression one could get when looking at the revenues of McDonald's is that they are doing really bad. Revenues rose until 2013, but fell ever since from $28 to around $21 billion in 2019. The margins, on the other hand, increased massively. Regarding the net margin, for example, it rose from 19.8% in 2013 to little more than 28.5% in 2019. This is a lot for a company in the restaurant sector. So despite the revenues decreasing, the earnings per share and with them the dividends increased nicely from $5.55 in 2013 up to almost $7.88 in 2019. Again, revenues fell by 25%, but by increasing their margin and also buying back shares, like you're going to see later, EPS rose by 42% from 2013 to 2019. How comes? This is the result of McDonald's radical franchising strategy. Franchise holders pay 10% of their revenues to McDonald's as rent, as well as 4% of the revenue for using the brand. Besides that, McDonald's earns money by delivering the product to the restaurants. By franchising, they lost some revenue that now goes to the franchise holders, but they also cut most of their ongoing cost, enabling them to have such a high net margin. Today, only 7% of the restaurants are operated by McDonald's themselves, which is why I assume that the revenues should not decrease dramatically anymore. Future growth could be achieved by further expansion to the emerging markets and digitalization of their restaurants. The charts of restaurant brands look a little different. Revenues exploded from 2014 to 2015, which is due to the merger of the said three companies. Since then, the revenues increased from $4 billion in 2015 up to $5.6 billion in 2019, 40%, whereby the net margin stayed stable around 10 to 11%. Like so, earnings did pretty much the same as the revenue. Looks like McDonald's has the better strategy on the first glance, but I think that Restaurant Brands is just in an earlier stadium. Relative to the already existing restaurants, they are expanding a lot faster and also operating more restaurants by themselves, leading to a lower net income. Talking about an earlier stadium, let's finally take a look at the development of Texas Roadhouse. And I have to say, I really like these charts, as I have rarely seen a company being able to increase both the revenue and earnings per share as stable as this company did. Since 2010, they increased their revenue by about 170% and the EPS even by 200%. For all those years, the net margin stayed stable at around 6%, which is due to the fact that they are not directly a fast food/franchise company. I mean, they as well have the franchising potential, but you can't order a 400 grams beef steak with fries on hand. If you're eating out at a Texas Roadhouse, you'll more likely sit down in the restaurant and stay for an hour. What leads us to the quarterly charts. Both McDonald's and Restaurant Brands had their earnings dip a little in the last quarters, but still stay positive. McDonald's even kept paying their dividend almost without losses. Offering food for takeaway and short waiting times really seemed to pay off. Texas Roadhouse, on the other hand, really struggled. They had to stop paying dividend, which is reasonable, and especially in the second quarter, they lost money. On the other hand, coming from minus 48 cents per share and 70.9 million shares outstanding, the loss amounted around $34 million. In contrast to that, 2019's EBIT was around $214 million. Like so, they will most probably be fine in the long run. To recapitulate the numbers. Each of the companies is currently situated in another stadium of growth. Just from looking at the impact on the fundamentals up to this point, every of the managements did a good job delivering steady results and leading the companies through the crisis. Texas Roadhouse is the company having the least franchises and is like so influenced the most by the pandemic. So far, so good. Let's discuss the final two charts and then get to the scoring systems. Especially at McDonald's, the dilutions chart is very interesting. They are massively buying back shares, having the numbers of outstanding shares reduced by 30% over the last 10 years. The black bar represents the diluted EPS change and the green bar shows the EPS change how it would have been without the buyback program, all in absolute numbers. And it stands out that without the buying back, the earnings growth wouldn't have been anywhere near the growth that they reported over the last years per share. Both assets and debts increased a lot at McDonald's, the debt increasing faster than the assets, resulting in a fast increasing debt ratio. What is also interesting is that 50% of McDonald's assets consist of treasury stocks. Both developments that investors should keep an eye on, as the balance sheet keeps getting worse. I mean, as an investor you should be happy if they buy back shares, as it accelerates the stock price's increase. But as soon as this is done with lended money, I start getting careful. Restaurant Brands emitted new shares and raised a credit in 2014 to finance the merger, I guess. Since then, the outstanding amount stayed pretty much the same, and so did the debt ratio. What you should consider before investing is that around $5.5 billion of the assets are goodwill. Texas Roadhouse's charts look quite healthy. It is striking again that their earnings growth is very consistent, accelerating a little in the last years. Outstanding shares stayed the same, just as their debt ratio until 2019, when they made some investments. You can see that because both core value and total liabilities increased. That's it with the charts. If you like what I do here, I'd be really happy if you could give this video a thumbs up. And if you don't, please tell me what I can do different. And if you wish me to analyze a company, of course, don't hesitate to tell me. Let's get to the scoring systems. Regarding the Piotrowski F-score, Restaurant Brands is ahead. They have positive returns and cash flows on assets, lowered liabilities and increased liquidity. The only deficiency is a declining productivity, but I'd say 0.94 is still okay. Simply put, productivity considers return on assets of the current and the last year. If the returns grew faster than the assets, the productivity increases. I made a video about the Piotrowski F-score, by the way, in which I talk about each of the figures in detail. What strikes the eye at this score is that both McD and Texas Roadhouse have higher returns and cash flows on assets. The increasing productivity is worse than at Restaurant Brands because both companies did some bigger investments in 2019. Also, McDonald's liabilities are very high. The next score considers a little longer time frame, and again it lets Restaurant Brands look pretty good. Especially earnings growth is very high, but as we saw earlier, this is entirely due to the merger in 2014. Their gross margin increased, the return on equity is high, and the debt is low relative to their EBIT. Also, they increased their dividends a lot. Texas Roadhouse is looking healthy as well. The categories in which they did not receive points are either due to the fact that they are a small company, I'm talking about the buybacks, due to the fact that they only pay dividends since 2011, and last but not least, to my disastrous way of calculating expected return on investment at the moment. This is going to improve as soon as I have time for it, I promise. Don't hate me, please. McDonald's score is not looking so lovely. The reason is mainly the franchising strategy and the high debt they have. The last score I have is pretty much the same score again, but set in context to all the other companies out of their respective sector. It takes a look at the individual figure, and if it scores better than 66% of their competitors, it receives a point. This score as well requires a little optimization, but it's a great indicator already if the company does well in its sector. And the picture is the same again. I don't want to repeat myself all the time. Pause the video and make yourself a picture of the figures. A small reminder, KUV is a German abbreviation and shows the market capitalization divided by the last reported annual revenue. At this point, I'd like to tell you again that I'm no financial advisor. I just want to help you at making your decisions by feeding you with the data I process in my tool. In addition to this video, I'd recommend you taking a look at the company's investor relation pages, and I'd also highly recommend you to check on news and outlooks published regarding these companies. But that's it now. Thank you so much for tuning in, and hopefully see you in another video. Stay rational.